This screencast lecture focuses on the second of the three main damage limitations. The certainty limitation is most frequently invoked and litigated in cases claiming lost profits. It's also commonly used to limit recovery when a breach allegedly causes damage to a company's goodwill or reputation. You read Drew's Company against Ledwith Wolf Associates. The case involves a troubled construction contract to create a restaurant space. Among other damages, the plaintiffs seek to recover profits lost because construction delays prevented them from operating the restaurant. Notice that the contract itself contains no express terms setting a deadline for completion. But the court finds an implied term giving the construction firm a reasonable time to complete performance. As you read, it's a jury question what's reasonable. In Drew's, the South Carolina Supreme Court joins other jurisdictions in abandoning the per se new business rule, which had barred any recovery of profits from a new business. Instead, the court adopts an evidentiary rule requiring proof of lost profits with reasonable certainty. Courts commonly contrast proof with reasonable certainty to what they describe as conjecture, speculation, and opinion not founded on facts. It's easy to see why this rule prevents recovery of lost profits in Drew's. The plaintiff's proof for this element of damages consisted of just two items of evidence: an informal statement of gross profits earned after opening, and the restaurant owner's own testimony that at least a third of that gross would be net profit. There were no records at all to document the restaurant's overhead or operating expenses. The court found that this proof was entirely too vague. It consisted of conjecture, speculation, and opinion not founded on facts. As a result, the court grants a JNOV, and the plaintiff loses a $14,000 jury verdict. Notice that, as in Freund, the certainty limitation arguably makes the damage measure undercompensatory. The restaurant probably had at least some net profit after opening, and thus probably lost something because of the delay. But the civil burden of proof is on the plaintiff. It's the attorney's job, that's your job, to develop an adequate evidentiary foundation for each element of the plaintiff's claim. Bear this need in mind. The certainty limitation also creates real problems for plaintiffs whose injuries include damage to their goodwill or business reputation. Lack of recovery for these speculative and difficult-to-measure losses makes contract damages predictably undercompensatory in some situations. For example, the note cases Harry Rubin and Michelin Tire reject claims due to defective products, and Redgrave against BSO accepts Lynn Redgrave's claim but slashes her damages. The certainty limitation thus creates significant uncertainty for the parties. You should counsel a client that recovery of lost profits from a new business, or for injury to business reputation, is far from a sure bet. It's difficult to predict whether or not such a claim will be successful. But there is one consistent pattern in these cases. Greater effort tends to be rewarded. We can compare the slapdash proof in Drew's to the careful evidentiary showing in Farah against Village Plaza. The plaintiff in Farah put on days of testimony, along with copious business records. So you can get an A for effort. Realize, though, that Farah is a fairly unusual case. New businesses often don't get lost profits. But, as the extensive restatement comments suggest, courts are increasingly willing to accept sophisticated economic and financial evidence to prove expected profits from a venture. On the one hand, that's a good thing. It comes closer to full compensation for loss. We're less likely to undercompensate. But there's still potential problems. Awarding lost profits from a new business could instead overcompensate the plaintiff. Let me explain briefly how that could happen. If you took both economics and accounting in college, you're probably already familiar with the distinctions between accounting profits and economic profits. For our purposes, the key fact is that accountants omit important costs. Entrepreneurs contribute capital and labor that they will sometimes be able to use elsewhere when a contract breach has occurred. Accounting profits generally leave out these costs and thus overstate how profitable a business really is. But the cost of these foregone opportunities is properly considered a cost of doing business. Doctrinally, that means that these could be costs saved as a result of breach. So what's the implication for damage calculations? If you base damages on accounting profits, but the plaintiff is able to move her capital or labor elsewhere and earn a comparable rate of return, then you overcompensate. This argument doesn't argue for no recovery at all, but it shows that lost profit recovery can sometimes be overcompensatory. Attorneys for breaching parties should argue that courts ought to take these costs into account whenever the promisee earned a return on redeployed capital or labor that offsets the losses resulting from the breach. Second, think about the risk of business failure. Awarding lost profits for a given period of time assumes that the business would have continued operating profitably throughout that period. This isn't a problem when the time period is short. But for a very long delay, awarding lost profits makes the breaching party a guarantor of the business's success. Again, this feature of lost profits recovery could make damages overcompensatory. Finally, contract damages are paid as a lump sum, but profits are a stream of payments received over a period of years. The solution to this problem is quite simple. The breaching party should argue that those future returns must be discounted to present value. Easy formulas exist to make the lump sum payment equal the amount necessary to generate the same stream of payments over time. Happily, courts have gotten much better about this issue. It's very rare now to see a damage award that doesn't discount future returns to their present value. The point is not to know precisely how to make any of these calculations. Instead, I'd like you to be alert to the subtleties of lost profits recovery and able to recognize when it might be good to call in a forensic economist or other financial consultant. Thanks for listening.